All right, what's going on, everybody? I'm here with the one, the only Joey Agree. And hey, it's like Mr. Rogers' neighborhood around here. You just never know who's going to show up. So thank you so very much for coming on by and answering a few questions for us.
My pleasure. My pleasure. Thank you.
All right, so first question, Joey. Your dad started Agree Realty in 1971, and he's executive chairman of the board right now. But from when he started until how Agree runs and operates right now, what are some of the biggest differences that you see in retail?
Well, in retail generally, look, my father started this company, this predecessor, Agree Development, in 1971 as a Kmart shopping center developer. Kmart was headquarters about 5 miles from where we're sitting right now in Troy, Michigan. Or at least I'm sitting right now in Troy, Michigan. He took it public in 1994 and never developed another shopping center and really transformed the company into a net lease REIT. With the advent of Borders Books, the bookstore traveled the country doing Borders transactions from Santa Monica, California to Aventura, Florida to their flagship in Ann Arbor, Michigan. Go Blue, got to add that after Saturday. And then the advent of the freestanding pharmacy with Walgreens. And so, look, the retail landscape today, we could spend hours talking about today versus 10 years ago, let alone 5 years ago or 50 years ago. It's a wholly different ball game. It's a different creature. I think the biggest change, obviously, is the omni-channel umbrella that we all live under today. This is a very powerful supercomputer. They certainly didn't have this in the 1970s, 80s, or 90s, right? And so that has changed. That's changed the game for both consumers, retailers, and everybody in between.
Dude, the computer. I mean, it's revolutionized everything. I want to get to that in a little bit, but second question I'm going to hit you with. So I've heard you mention, and I don't know why I haven't heard anyone else mention fungible rectangles. I mean, I just love that. I think I'm going to get a shirt made up. I heart fungible rectangles. So, what exactly is a fungible rectangle?
So we've got a great white paper on our website. I encourage everybody to go to agreerealty.com, just scroll down on the homepage under ADC Knowledge Base. We put out these white papers on there. A fungible rectangle is a rectangle, obviously, maybe a square, but generally retailers are in the form of rectangles that have residuals that are adaptable and reusable upon expiration of that lease for whatever reason, whether it's a rejection in bankruptcy, a natural expiration of a lease, that have the adaptive reuse that will drive demand to drive ultimately the releasing of that box. You know, we juxtapose that against the Palace of Auburn Hills, just using a local former icon here, which was where the Pistons used to play before they moved downtown. It's when they used to be good too, and they used to win championships when I was younger. The Palace, the replacement cost of the Palace would probably be $1 billion today. But guess what? It was a 21,000 square foot basketball arena. It sold for $20 million. They tore it down for land value. Now, let's use a more relevant example today, Topgolf. Now, people ask me all the time, why don't you buy Topgolfs? And I say, number one, I don't play golf. I don't know much about it. I've been at Topgolf a couple of times. But most importantly for us, Topgolf is, I don't know what I would do with that building upon expiration or rejection, regardless of their challenges today with Callaway. It's not a fungible rectangle. And so what we like to focus on here is rectangles. Look, all retailers, all companies go away. Jeff Bezos has been, people, they throw up their hands and then they can't believe when he says one day Amazon won't be here. Well, hearkening back to your prior question, Kmart was the biggest retailer in the world. It was 5 miles that way. They had a AA or AAA credit rating. They're gone. So eventually, real estate and cap rates and underwriting is assuming into perpetuity or until the building degrades to its natural life. And so we want to acquire properties that are specifically beyond their current state, that have demand drivers, that are fungible rectangles. That whether it's an auto parts store today, it could be Russ and Joey's. We could start a business. You name it, Russ. In the future. It could be multiple different uses. I can't say that for a stadium, a casino, Topgolf, and lots of other retail uses that we see out there.
Car washes come to mind, so that's kind of cool. Just
120-foot tunnels, can't do anything with those either except a car wash.
So I want to preface this question. I am a shareholder in Agree Realty. I have been actually since I followed your line. I was on the fence about getting in, and it's public knowledge. I love seeing when CEOs buy shares of their own company. It just gives me the warm and fuzzies. So in February of 2024, I saw you picked up shares of Agree Realty, and I followed suit, and I've been a shareholder ever since. I intend holding for many, many years. One thing I do, I work on commercial industrial loading dock equipment, so like dock plates and warehouses. I worked at one today, and it's a rectangle, and I've seen companies, they move out, they move in. I know we're retail, so would Agree Realty ever consider getting in, maybe encroaching on Prologis, as we do work, my company does for Prologis? Would you ever look at an industrial fungible rectangle?
No. And for one specific reason, it's not our core competency. Russ, you were in the Navy. I thank you for your service. If they put you on an airplane, what would you have done? Right? It's just not what we do. This is a team that is built around its core competency, its experience, its talents, its systems, its processes, its relationships, frankly, in the retail real estate space, specifically in net lease. And so I tell investors, diversification can be achieved by buying multiple different companies, right? By buying Prologis or an ADC or any other REIT or investment vehicle. I think straying from your core competency in terms of REITdom hasn't worked historically. And I think it hasn't worked for a reason. Pick the best management team that knows what they're doing, right? If you want to go to sea, I'm going with the Navy, right? If you want to go to the air, I may still go with the Navy, but I'm going with the Air Force. And so it's not what we do. I grew up on a construction site for a retail shopping center, grew up in the net lease business. I built and hired a team here and trained a team to be experts in their respective field. And we're going to stick to our knitting.
Yeah, so whether you're a retail investor or you're a big fund manager or CEO of a company, like Buffett and Munger would say, that circle of competence. Everybody watching knows I may be in a cult sometimes with the Buffett and Munger stuff, but a lot of good wisdom there.
That's Jim Collins would call it the hedgehog concept. It's the same thing. We are retail experts. We are not industrial experts. If I want to invest in industrial, I'd go pick the best industrial management.
Number 3. So what makes you decide if a tenant is right for ADC? What are some qualities I guess you do or don't look for?
So we talked about the underwriting from the bottoms up, the fungible rectangles. The 30,000 foot perspective starts with, again, that omni-channel vision of the future. And we're here now. The future's here, and call it the 6th inning of an omni-channel world today. Maybe an extra inning or two, we'll see. I think this holiday season will demonstrate a lot, especially given the oddities we've seen in the last few years of COVID and surge sales and pandemic sales and all those different types of modalities being executed on in terms of BOPIS and ship to home and pick up in store and lockers. We start with that 30,000 foot perspective of non-discretionary, recession resistant retail. That's first and foremost. We don't buy anything that's fun. We don't do fun. We don't do food unless it's on a ground lease. So we don't do discretionary. Then we say who are the biggest and best operators in those respective sectors. Obviously, our largest tenant, we're their largest landlord, retail landlord, is Walmart. Who are the biggest and best? Who have the balance sheets to invest in 3 things? You've probably heard me say it on earnings calls and else. Labor, right? Labor is more expensive today than it ever was. E-commerce, fulfillment, and omni-channel. These are expensive investments. They are huge, massive investments. You see it pulling through now for Walmart's results. I think we'll see it over the holiday season. And then lastly, in price. Again, this powerful little supercomputer that fits in your pocket gives the consumer full leverage to understand price transparency anywhere in the world at any time on any good. And so we invest in the biggest and best, then we drive down, we call that our sandbox of the 30 biggest and best retailers in the world, or the country, I should say. And then we drive down to the asset level, those fungible rectangles, looking at the demographics, the traffic, the synergy, the store level performance, the rents per square foot, what's happening in that respective submarket. And so we call that the funnel. Everything goes through that screen. And then it's bracketed by different thresholds, right? Thresholds from a sector or a tenant perspective, a geographic perspective to ensure, frankly, we maintain a diversified portfolio.
So I like the funnel concept, and I just thought of a screen, and you said no food, no fun, And I'm going to
No
kind
food,
of
no prepared food. The most difficult retail business in the country is the restaurant business. I don't want to own their real estate, right? We can open Joey and Russ's Coney Island or Joey and Russ's Hamburgers. We don't want to own their real estate. That's not, it's a challenging, difficult business. So food for off-premises consumption, grocery stores, sure. Kroger's a top tenant of ours. Obviously, grocery is a huge component of Walmart's business. But no, we don't want to be serving hot dogs and hamburgers.
So what I was going to get to is the other F. Now, I went to Cook County. I graduated at Cook County School, so not the best education, but I'll go with the other F, pharmacy, and I'm going to just load this question for you. I want to encourage everybody. I'll have a link for it for the investor presentation. Beautifully done. But one slide in there is just, it looks prescient. It's crazy, is Walgreens, that in 2012 you had 30% exposure, and then I think in 2021 it was down to 1%. That was a time when being selective really paid off. What made you say, now we got to start getting out of Walgreens way before we saw their stock price just collapse and they're looking like they might be in a bit of a pickle?
So I've got a long history with Walgreens. As I mentioned, the history of the company. My father's first Walgreens he developed was in a outlet to a shopping center in Florida. And Walgreens called them and said they were in line in the shopping center. It's a Kmart anchored center. And they said, we want to move to the hard corner in a freestanding format with a drive-through. And that was the advent of the prototypical suburban pharmacy as we know it today. And so the company went on under my father's stewardship, and then prior to me launching the acquisition platform in 2010, to develop about 45 Walgreens in 5 or 6 states. When I launched the acquisition platform in 2010, we had 72 properties, 45% of which was Walmart, 75% of which was Walgreens. Mm-hmm. Walgreens, Kmart, and Borders was 75% of our NOI. As we moved through the years and I launched the acquisition platform, I'd walk into the pharmacy, and Walgreens specifically, we were no longer developing them post-GFC, the great financial crisis. And I would see the increasing, frankly, lack of relevance and price competitiveness in the assortment on the front end. Yes, I'd fill my scripts up at the store. Yes, today I still go there for one other reason besides picking up a script. It's to pick up a card, which pains me, for $9 for Valentine's Day, my wife's anniversary, and her birthday. Valentine's Day, I'm always the guy there, the morning of, picking up a card with the other 3 jerks, right, handing them to each other. Here, you want this one? But if you walk around the front end of a Walgreens specifically today, which is, approximately 12,000 square feet. If you walk around and you say, what would I buy here? It's pretty difficult to figure out what you buy there. When I need toothpaste, I order again, bam, next day. Same price or cheaper, comes to the door. So you can take all those, those health aids, let's call it, all the health stuff. The beauty stuff, Sephora and Ulta is effectively out taking share from the malls, and the pharmacies have never gained traction here like Boots Alliance did, now the parent company, effectively to Walgreens in Western Europe. Women shopped at the mall, now it's Ulta and Sephora. The snacks, the food, the coolers, the large format C-stores have taken that share. They're better at it. It's faster. You're in, you're out. They also have prepared foods and beverages, coffee, soft drinks. And so the value proposition today of the suburban pharmacy is diminished dramatically, specifically Walgreens. Real challenges there. Second, I would tell you the rents per square foot on those rectangles, back to fungible rectangles, are they're disproportionate. Which you'll see today, the backfill generally for a suburban pharmacy is a dollar store. And they're paying about 1/3 to 1/4 of the rent that the Walgreens used to pay. Walgreens is, in fact, Dollar Tree's largest landlord. They sublease that many Dollar Trees. And so a 14 or 13,000 square foot box, it's great underlying dirt, 1.5 to 2 acres. But the problem is that 13 to 14,000 square foot improvements isn't a fungible rectangle at the end of the day. Very few retailers today use 13 or 14,000 feet. It's too small for an Aldi or a Junior Box, a TJX, a Ross. Those are 20 to 25,000 square feet. And then it's too big for the other guys. And so it's they're in a tough spot. Now, we've invested in CVS, select CVSs with lower bases. I want to be clear, the pharmacies aren't going away in this country. It's not going to disappear, pharmacies. Pharmacy space won't be gone. Just like the movie theater space won't be disappear. What we need in this country is a rationalization. We're over-pharmacied, we're over-screened in terms of the movies. We've seen a rationalization with Rite Aid's bankruptcy, Walgreens store closure announcements. And in my opinion, Walgreens will have to file bankruptcy in 3 to 5 years to reject all these lease liabilities.
No, and it makes sense. It's just, hey, like you said, some people say there's too many banks, and say in the United States we need a rationalization of banks as well. So,
but the bank, it's an interesting point you made, because if you look at the bank sector, there are commercial banks that are expanding their footprints, led by Chase. There are commercial banks that are rationalizing their footprints and shrinking it. But banking, although it has gone online, many of the things you can do have gone online. The use of cash has diminished greatly. But banks have transitioned their service model from the banking branch of yesteryear. You walk in today, there's 8 offices and cubicles. So it's not for traditional deposit work that they're focused on. It's for face-to-face interactions. Otherwise, we're going to go to JP Morgan in New York. It's face-to-face interactions for home loans, boat loans, small business loans, all of the other type of cross-selling that they can effectively navigate through face-to-face interactions. So banks, the good banks, led by JP Morgan, they have really just repurposed what they do inside of those 4 walls. Pharmacies, look, they've tried through clinics, they've tried through different forms of healthcare, but it hasn't been effective.
well, I guess we'll see. And but still, it's impressive. It's impressive that you got that track record, that you saw the writing on the wall. And as an investor, again, it just, like I said, I don't know a better way to say it. It gives me the warm and fuzzies to have a good management team in place, and you need to have that management team, So it's very important. So something I'd like you to tell me more about. Our question number 4 here is something that may be a little bit more advanced, and I think I understand it. But your forward share sales. Now that's something that you think you guys were the first to do. Is there a real simple explanation you can give us for the forward share sales, and why do you use them, and how might it be beneficial to the shareholders?
So prior to our first forward equity offering, I was thinking it's commonplace in commercial finance to use forward starting swaps to hedge interest rate risk. We utilize forward starting swaps. We've disclosed that we have $200 million in current forward starting swaps on the 10-year Treasury, swapped at 3.7%. You win some, you lose some. Obviously, that one's in the money. And I said to myself, why hasn't any net lease REIT, shopping center REITs, and other corporates have used forward equity, which is effectively the bank borrowing shares? That's why you'll see our short interest go up, and then reselling those shares. We have the capital in an interest-bearing account, and we can settle it at any time, typically within 12 months. Just deliver the shares, the short gets settled, right? And we get unrestricted use of the cash plus the interest. If you look at net lease REIT, specifically our balance sheet, it's 75% equity, 25% debt. Now we're using swaps to mitigate interest rate volatility on the 25%. But I said, how come no net lease REIT how come they've never used forward equity? We know we're going to deploy hundreds of millions, if not billions of dollars in capital through acquisitions, our developer funding platform, organic development. Other REITs have done it, typically to match fund projects, redevelopments, or large scale projects. I said, if all of our little onesie twosies, the $4 or $5 million transactions, add up to the same amount of capital, why can't we do that? And the banker said, well, I guess you could. And I said, well, I want to. I said, look, I want an intermediate perspective into our cost of capital for the next 4 months, 6 months, 12 months. Today we have, $1.1 billion of forward equity outstanding. I want to be able to plan for 2025. Guess what? We can do it now. No matter what happens in the market, no matter what happens to our stock price, our cost of equity capital is locked in to the tune of $1.1 billion in forward equity. Just-in-time financing in a REIT business like the net lease REIT that we are today, it's an external growth vehicle that pays out 100% of taxable income to shareholders. We retain about $100 million in free cash flow after the dividend. Just-in-time financing works if you're just in time. We went the other way. We said we're running a business here, right? There are 80 families at this company that depend on it, and shareholders like yourself that depend on our performance. Why would we wait for just-in-time financing when I don't know what's going to happen next week, next month, let alone next February, March, June, July? And so we executed the first forward equity offering in the net lease space. I think it was 2017 or 18. Since then, 85% of equity offerings in the net lease space have been on a forward basis. And I think it just makes too much sense. I mean, I tell everyone there's two components to net lease. Really, the real estate investing on a programmatic basis. It's the heart. It's your capital, your debt, your equity, whatever that capital structure looks at. It's got to keep pumping, especially when you're a net lease REIT, right? You got to have a strong heart. And then it's your brain, your uses. Where are you? We talked about rectangles. Mm-hmm. What are you using that capital for? We want those to be working in sync. We want to be able to have a business plan on a go-forward basis that isn't subject to macroeconomics, domestic politics, and geopolitical affairs, that we can deliver consistency and predictably returns, AFFO per share growth, driving to dividend growth for our shareholders.
If I hear it a little bit right, it's almost like an insurance policy.
It's a swap. It's a swap.
Right, and it helps with the planning, right? It helps with the future planning and makes things a little bit more streamlined.
It helps with future planning. It helps with strategic planning down to tactical planning, all the way down to where are you going to allocate capital? How are you going to, your talent management system? Where you need to retain, recruit, hire, build, buy capabilities. And so today, look, we have $2.3 billion of liquidity we're sitting on, and we don't have to worry about any volatility in the capital markets next year because it's sourced, it's in the bank, and it's at our call.
Fantastic. Thank you for breaking that down. I really appreciate it. We're going to be respectful of your time. Wrap it up with the last one. So these guys, they're international. Your friend Brad Thomas was on the Dividend Talk podcast. I love them. They got a European flavor. They actually put Agree Realty on my radar. Going to shout out Dividend Talk podcast, and I asked them to come up with a question. So they want to know from you, how do you balance growing the business while keeping the dividend sustainable through different economic cycles?
It's pretty simple. We grow the dividend in line with AFFO or just slightly under. Again, our payout ratio on AFFO using close to a cash metric is I think 73.5%, 74%. So it's an extremely well covered dividend. Again, that excess 25+% is the free cash flow after dividend, the $100 million I talked about. The dividend here is sacrosanct. It's not touchable. And so we grow the dividend as the business scales and continues to grow and throw off more AFFO and more cash. And so we converted to a monthly dividend 3-4 years ago. There's no downside for us to do it. I thought it was only upside. I love receiving it every month and not waiting quarterly. But it is sacrosanct. It is underpinned by what I think is the best balance sheet in all of REITdom. We talked about the forward equity, and then I think the strongest retail portfolio in the country. And so that dividend is not going to be cut on my watch.
I love it, man. Thank you. So I know that's it. That's all I got for you. I wanted to keep it short and sweet, and hopefully put your company on some more people's radars, because I think it's fantastic. I'm kind of sore that the share price ran up so much. What's it up almost 20% year to date? I think it
was due for a correction. Look.
Yeah. So. I'd like to add more. I might wait a little bit, but we'll see. So, Joey, thank you so very much for this. I really do appreciate it. And yeah, man, thank you for stopping by. And to everybody else, have a fantastic day.
Thanks for having me, Russ. And again, thank you for your service.